Welcome to the FedLife podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
And hello and welcome to this episode of the FedLife podcast. I am back. I am your host, Dan Sipe. Additionally, I'm the branch manager here at Serving Those Who Serve, Sipe and Associates. And I want to do, as I always do, and begin by thanking you for taking the time to listen and thanking you for your service. You do not hear that enough. You'll always hear it here. The other thing you'll always hear with us is the guru, Ed Zurndorfer. He is back with us once again as part of our ongoing mission to reach, teach, and serve you. Now, at the outset, as I always do, to keep my compliance department happy, I need to say the opinions of our guest, Ed Zurndorfer, are not the opinions of Raymond James or Serving Those Who Serve. This podcast is presented for information only and is not meant to be taken as advice. All listeners should consult their personal advisors before taking any action. If you are lacking in personal advisors, hit us up at Serving Those Who Serve. We will do whatever we can to help you. Once again, we will follow Ed's FEDZONE articles, and we are still to the matter at hand. It's that time of year. Some of you may know this, some of you may not, so I will certainly share it. Ed, in addition to being the guru of all things federal benefits, is also an enrolled agent with the IRS and has a tax practice. So this time of year, we're talking taxes, and specifically, we're going to be talking how TSP withdrawals are taxed. So, okay, Ed, we begin with your fifth article in the tax series, which is Taxation of TSP Withdrawals. And you begin with the premise, which we hope everybody knows, that any withdrawal from a traditional TSP will be taxable. And as such, there will most likely be some tax withholding taking place, and feds do have some choice there. So why don't we open up with that?
Yes, Dan. I have to say again that with the TSP, there are two types of TSP accounts. One is a traditional TSP account, and the other is a Roth TSP account. And we're going to be talking about the tax consequences of withdrawals, distributions from each account. We're going to start off with the traditional account, which is probably the easier one. Because at the outset, I have to tell you that all withdrawals from the traditional TSP are fully federal, and in states that have state income taxes, state taxable, the entire amount. And the reason is that the money that was contributed to the traditional TSP from an employee's paycheck came from their gross salary, not their pre-tax salary. So it was put in before federal and state income taxes were taken out. The money went into their traditional TSP account, invested in the various funds or life cycle funds, got earnings, whether it's dividends, interest, capital gains, none of which was ever taxed until the TSP participant decided, I want to withdraw the money. And therefore, everything coming out, which includes the employee's contributions, those earnings, and I have to also say that FERS employees get that automatic 1% of their gross pay contribution and matching contributions from their agency, that also is fully taxable when withdrawn. So all withdrawals from a traditional TSP account, the entire amount is fully taxable.
Gotcha. Okay. And so your tables are always great, but this one is really awesome and super clear. And typically I just refer people to it, but I think we can touch on some of these options, so people will have a little bit of a highlight to it. So first up from your table, you have the single withdrawal, which could be full or partial, and you note that that's a withholding rate of 20%, and that's automatic?
Yes, that's going to be an automatic. Let me just say one thing, Dan, that the fact that the TSP is withholding federal, and emphasize federal, because the TSP does not withhold any state income taxes. But the TSP is required by IRS rules. It's not the TSP rule, it's the IRS rules to withhold a portion of a traditional TSP participant's request withdrawal for federal income tax purposes. And with certain types of withdrawals, the TSP participant may require an increase or a decrease in the percentage of federal income taxes being withheld. It's not a dollar amount, it's a percentage amount. Or in some cases, they can request actually a waiver of federal income tax withholding, and we're going to cover that. So this is the list. When it comes to a single withdrawal, the TSP will automatically withhold 20% of the amount being requested for withdrawal. So if someone requests, let's say, a withdrawal of $20,000, that would be a partial withdrawal. They're not taking out their entire account. They're just making a single withdrawal of $20,000. Then 20% of $20,000 is what, $4,000.
Yep.
$4,000. So the $4,000 in federal income taxes will be withheld from the $20,000 distribution, leaving a net of $16,000 to the TSP participant. That withholding amount, the 20%, Dan, can be increased. Maybe the individuals in a higher federal marginal tax bracket. Maybe they're in let's say, a 32% or a 35% bracket. They can request a higher percentage, but they cannot repeat. They cannot decrease to 20%, nor can they waive that withholding.
Got it. And I notice on the list that even if they take installment payments, if they're less than 10 years, it's kind of the same rules, correct?
That's exactly right. The 20% is going to be the minimum. They can increase it, but they cannot decrease it, nor can they waive it.
And then the next one's kind of interesting because it definitely jumps away from numbers. Okay, so folks, go to this chart because, taxes never make you smile, but this one kind of made me smile a little bit because it's like, first one 20%, first one 20%. Second one is as if married with 3 dependents. Tell us about that one, Ed.
The TSP has access to a tax table, federal tax tables, and if they could be single or married with 1 dependent, 2 dependents, 3 dependents, whatever, and they're requesting installment payments. Installment payments means that they're getting a certain amount of money that are expected to last for more than 10 years. For example, suppose somebody has $1 million in a TSP account and wants to get, for example, $1,000 a month. That's $12,000 a year. So do the math here. If they did it for 10 years, they would take out a total of $120,000. That those installment payments could last for more than 10 years. That being said, if they request that, then the TSP will go to the table based on the amount they're withdrawing and go to the table and figure out, well, based on the person being married and having 2 dependents, what is the withholding amount? What is the dollar withholding amount? That amount can be increased. The person could go to a percentage if it turns out that they want more to be, let's say, more than the married and 3 dependents, whatever that dollar amount is. They can actually decrease that. And believe it or not, Dan, they can waive it entirely, saying, no, don't take out any tax. Don't take out any federal tax. That they can waive.
Interesting. And I see that applies to installment payments for more than 10 years and also installment payments based on life expectancy, which kind of makes sense because you'd probably be going longer than 10 years with that. And in both cases, they can raise, lower, or waive. That
actually... They cannot. That is correct. Except I don't think they can. They can decrease it. They cannot decrease it. They can waive it though. Believe it or not. Either they can. That's from the TSP tables. They cannot decrease the amount of withholding if they have installment payments based on life expectancy table. However, they can say don't do it at all.
Okay. So it's, wow. That's a bit of a gamble for me
Yeah.
I don't want Uncle coming once a year for a big check. Then we go to required minimum distributions, RMDs. Okay, so that means right now I've gotten to where I'm 72 and I haven't taken anything out, and so TSP is going to start sending it to me, and they're going to withhold 10% automatically, correct?
That's correct. And one can increase that more than 10%. If somebody wants 20%, somebody wants 30%, 40% taken out in federal tax, they cannot decrease it, but they can waive it.
Okay, got it. And then up next, we have something that I hope nobody ever needs.
Yes.
Which is financial hardship in service withdrawal. So that means you've hit a really, really, really tough stretch economically. And folks, this is not taking a loan. This is actually qualifying for the withdrawal. And in that case, Ed, they're exempt from the 10% penalty, yes?
The 10% early withdrawal penalty, yes.
Yes.
Okay.
And so TSP is going to do an automatic 10% from that. And once again, according to your table, it looks like that can be increased, decreased, and can also be waived.
That is correct. But please, as you mentioned, Dan, please, TSP participants, by all means, try to avoid a financial hardship withdrawal. Please.
Absolutely. Absolutely. It hurts you twice. Then last but not least on this, we have the age-based in-service withdrawal. And what that means is somebody's been working, they've reached 59 and a half, and they have the ability to take withdrawals. A lot of folks will equate that with they can transfer it somewhere, but they could also withdraw money to use. And in that case, we're back to that 20% withholding.
That is correct. If you're in service, if you're still in federal service and you're at least age 59 and a half, you can request withdrawals from your TSP, your TSP account, even though you're still in federal service. It means you're still contributing to the TSP, but now you're taking money out. And if you do take the money out, it's going to be a mandatory 20% withholding. You can increase that amount. You cannot decrease that amount, and you cannot waive it. They're going to take out 20% minimum. It's mandatory. It's mandatory 20% withholding.
Gotcha. Okay. All right. So let's press on with your article, and your next topic within it is, and we touched on it briefly on this chart, is that 10% early withdrawal penalty tax. So again, folks, to reiterate, these are long-term vehicles for savings and retirement. You go into them before 59 and a half. In most cases, you're subject to a 10% early withdrawal penalty in addition to the taxes that you owe. But Ed, you have some instances here where that would not be the case. And first one up is a TSP person who reached age 55, and I'm assuming has severed or retired, correct?
That is correct, Dan. That is correct.
And age 50 if they're a public safety employee.
What's called a special provision employee, a special provision
special
employee.
Provisions.
Special provision employees include law enforcement officers, LEOs, federal firefighters, and federal air traffic controllers. But I have to tell you, Dan, it's a little misunderstanding. And if I can make a plug here for one of our webinars that we do.
Plug away.
Please. We talk about this, about withdrawals from the TSP account, including this 10% early withdrawal penalty during our TSP webinars. And if I can, the next TSP webinar, we have them every month, Dan. We have them every month. Our next TSP webinar will be held on Thursday, April the 21st from 1 to 4. It's up on the Serving Those Who Serve website, www.stwserve.com. It'll say TSP webinar. And even if you've attended one before, you can attend as many as you want. It's free. All you have to do is sign up. please spread the word, because we talk a lot about every aspect of the TSP. And I think if you've never attended a TSP seminar, webinar, it's a good idea, because there's so many things that you really have to know about the TSP that will help you later on. Later on and currently investing in, putting the money in, all the little things here we talk about that are so important.
And I will add a plug on your plug, Ed, because in case folks, because we never know when people are going to get around to listening to the podcast. If you listen to this and it's go, oh my goodness, April 22nd. Oh no, have no fear. We do them every month. The next one after that will be May 17th.
That's correct. And we have one in June, July. You have it every month.
Yep. Go to the website. We always have at least two options up there, but Ed is a warrior. I mean, he's booked all the way out through the end of the year, so you don't have to look at it and go, oh my goodness, I missed my only opportunity.
Yeah, you never miss an opportunity. You always have another chance.
Exactly.
But I just
by God's grace, if we're still here.
I want to mention about the special provision employees, because there may be some out there. There's a little misunderstanding there that the law was actually changed back in 2014, in which if a special provision employee retires, and most of them can retire at age 55. For example, if you're a law enforcement officer or a firefighter, you can retire with 25 years of service at any age. If you have at least 20 years of law enforcement service or firefighter service, you can retire at age 50 with a minimum 20 years. So that's before age 55. Same thing is true with air traffic controllers. I think they have to retire a little bit earlier. I think maybe it's 55. But whatever it is, it's before they're 55. But here's the point, Dan, that those individuals, many of whom do retire before age 55, they can make penalty-free withdrawals from their TSP account, but only if they retire sometime during the year that they turn age 50. They could retire, as I said, they can retire with 25 years of service before age 50, but if they do, then in order to make penalty-free withdrawals from your TSP account, no 10% early withdrawal penalty, they're going to have to wait till 59 and a half. Not very good, okay? So a law enforcement officer, a firefighter, air traffic controller has to keep that in mind. They can't retire before age 50 and expect to take money out of their TSP account. Before they have they have to retire sometime after they turn age 50. Now, everyone else who is not a special provision employee, they can make penalty-free, no early withdrawal penalty withdrawals from their traditional TSP account if they retire sometime during or after the year they turn 55. 55, Dan.
Gotcha.
Now, I look at the details. I have this habit. I look at all the details.
Sure.
And I got a question from someone on my various sources I get questions from. And the person had a very legitimate question. And he said, I'm a federal employee, but I have a friend who works in private industry. And my friend has a 401k plan, which is the equivalent of the TSP. You work in private industry. Your company has a 401k, it's a qualified retirement plan. You put money in pre-tax. And he told me that he also can take money out of his 401k plan when he turns 55.
Yes.
So I said, what's the problem? He said, well, my friend turned 55 years old one year, and he retired from his company in June of that year while he was 54. And he thought he could take money out of his 401k because he's turning 55 that year, the year he's retiring. Even though at the time he retired, he was 54. And he was told, if you do, you're going to be subject to a 10% withdrawal penalty. So I looked into this, and I told the person that 401k plans are different. In order to take the money out of the 401k plan and not be subject to the 10% withdrawal penalty, you have to retire sometime, either the month you turn 55 or sometime thereafter. If you retire any time before the month you turn 55, then you're going to pay a 10% withdrawal penalty. That is not the case with the TSP. What the TSP says is that as long as you're turning 55 in the year that you're going to retire, you could be 50, you could be 54, you could be 54 years and 3 months. Let's say you retire in March of a year in which you're 54 years and 3 months, and then you're going to turn 55 in December. It's the same calendar year. It's different. Once again, the devil is in the details.
Sure. No, it always is. So let's press on through your list here, because up next is up to $5,000 worth of any payment that's connected to birth or qualified adoption. So that's a cool thing.
Yes, this is something recent. It came about as a result of the CARES Act. But remember the CARES Act back in March 2020? Yep. The Congress made some provisions to qualify retirement plans, allowing individuals to take $5,000 out of their qualified retirement plan, and that would include also the TSP if they had a child or they adopted a child. And the reason is because the economy, what happened with the start of COVID, they felt sorry for people who had this now expense of now a child, and the economy being down, so they put that provision in there.
Okay. And then up next, you show annuity payments made by the purchase of a TSP annuity. That would be something that goes through MetLife, so there wouldn't be any penalty associated with those payments, correct?
That is correct, because what you're doing is when someone retires from federal service, they may retire before age 55. This is not a special provision employee. So I've gotten this question many times. Well, I really need to get to my TSP. Is there any way I can get to my TSP and not be subject to 10% early withdrawal penalty? And I said there are two methods, and I'll get to the second method here, but this is the first one. You could purchase with a portion of your TSP account a fixed annuity, and you're purchasing through the TSP from Metropolitan Life Insurance Company, in which Metropolitan Life Insurance Company will give you a guaranteed payment for life based on the amount of your TSP account you're turning over to them and your age when you buy this annuity, and they're going to guarantee you a payment for life. That's what I mean. No matter how long you live, you're going to get this guaranteed payment. It's called a life annuity. And it's not, you got to pay federal tax and you got to pay state tax, but no 10% early withdrawal penalty. But Dan, once again, this annuity is not for everyone. Please.
Devil's in the details.
Talk to a qualified advisor, an accountant, whatever, before you do this. It is there's some what I call this annuity has what I call I gotcha.
And actually, we'll come back to the ones in the middle. Let's jump to the end, because I think this is the other one you were alluding to.
Yes.
And that is substantially equal payments over the TSP participant's life expectancy. So that's another way that you won't get hit with a 10% penalty. Why don't you walk folks through that? Yes.
So what you're going to do is you're going to tell the TSP that I'd like to, and this is in accordance with IRS code the Internal Revenue Code section 72T, that the TSP is going to give you a monthly payment based on your age at the time you turn over part of your TSP account to the TSP, in which the TSP is going to pay you a certain amount, a fixed amount, And even though you have to pay federal and state tax on it, there's going to be no 10% early withdrawal penalty. But Dan, once again, you have to be very careful about this, because when I say number one, substantially equal payments, that's what it is. I mean, you're going to basically get the same amount based. Well, I should say not the same amount. You're going to get an amount based on your account balance that varies over time, and your I should say your age as you get older. They're going to recompute the payments each year, but the payments have to last for at least 5 years. Actually, the later 5 years, or until you turn age 59 and a half. Because if you decide this is not for you, and you decide, oh, I don't want to do this anymore, then if you have not fulfilled the minimum 5 years, or age 50, or attained age 59 and a half, you're going to be subject to a 10% early withdrawal penalty, retroactive to day one. Please. Yep. Anybody thinking about doing this, talk to a qualified advisor about this. There's so many downsides. There's just so many I got you on these things.
Sure. And, and let's move pretty quickly through through the rest of the list. So for example, if somebody's getting payments as a beneficiary, meaning someone else has died and left them a TSP account, and they're under 59, they're not going to be penalized for that. If it's
correct,
it's due to a domestic relations order, as a result of a divorce or something like that.
Yes,
not going to be hit then. And God forbid somebody is totally and permanently disabled, and they're accessing. IRS is not going to pile on. There's one here that I must confess, I wasn't. Well, actually, there's one more before I jump to that. And again, God forbid somebody has so many medical expenses that exceeds 77.5% of their AGI, and they made a withdrawal. They wouldn't be subject to a penalty during that year as well. But there's one in here that I didn't recognize. I've been doing this a long time, but every now and again I see something that I haven't seen as yet. Automatic enrollment refunds. Explain that one to me.
Okay, Dan. When under a law that took effect about 12 years ago, when someone is hired, they are automatically enrolled in the TSP. That is, what I mean by that, during their first pay period, 5% of their paycheck will automatically be put into the traditional TSP.
Gotcha.
We've come a long way, because I remember when the TSP first started in 1987, I was in the government. You couldn't start in the TSP for a minimum 2 years. You had to wait.
Sure.
But that subsequently changed. So starting in 2010, they said anybody hired will automatically be enrolled. And back in those days, it was 3%, and I think last October they changed it to an automatic 5% of their first paycheck will go into the TSP. Well, the employee has the option to say, "Hey, I really don't want to put money into the TSP. I really don't. I have other investments. I don't think it's I'm not making judgment here, Dan. I'm just saying this is what some employees may feel, and they have that right. So what do? The employee fills out Form TSP-25, which means a refund of any money that was put into the TSP. I think they have to do that within the first 6 months of their federal service, and they get all the money they put in. During that period when before this took effect, they will get back with no penalty. No penalty. Okay.
Interesting.
So that's what that's all about.
Gotcha. All right. Well, let's press forward, because now we're heading into the Roth TSP, and boy, you know as well as I do, brother, there are so many misconceptions about Roth TSP. Oh my God. I really do wish I had a nickel for every time somebody is, when I've asked them if they're participating in Roth TSP, they say things like, "No, I make too much money," and things like that. But let's dig into the withdrawal side, because I'm sure there's plenty of misconception here that you're going to be able to clear up. First thing you come into is there's two conditions, and both must be met if somebody's going to withdraw from Roth TSP.
Okay, so let's say it very slowly. In order for a Roth TSP participant, someone who has been contributing, an employee, or I should say also a member of the Uniformed Services, because a member of the Uniformed Services can also contribute to the TSP.
Absolutely.
So an individual has put money into the Roth TSP in order to make penalty and tax-free, I repeat, tax-free withdrawals from the Roth TSP. Two conditions have to be met. Number one, the Roth TSP participant has to be at least age 59 and a half, or they're permanently disabled, or they have died. And the reason I'm saying had died is because if that person has a Roth TSP account and they've named a beneficiary of their Roth TSP account, then the beneficiaries can take the money out. Okay. So let's be a little more positive here. The individual has to be at least age 59 and a half. Okay.
Yes.
And the other condition, and this is where there's a lot of confusion, Dan. It has to be at least 5 years since January 1st of the first year the Roth TSP participant made his or her first Roth TSP contribution via payroll deduction.
Okay.
So I think it's a lot easier.
Whatever time they started during the year, it goes back to that January. So
exactly.
I woke up in November and said, hey, or better yet, I met somebody from Serving Those Who Serve. They told me I could be doing this. So let's say it's August when they do it. It's still going to count from January.
That's correct. The previous January. The previous January. That's correct. Now, I want to point out that the Roth TSP started in the year 2012.
Mm-hmm.
Okay. And also, I want to say again, it goes back to the very first Roth TSP contribution. Subsequent Roth TSP contributions, you don't have to worry about this 5-year rule.
Gotcha.
I'd like to share. Go ahead.
Yep. Now, I'll tell you, I mean, you and I have been doing this a long time. And for the longest time, I felt that VCP for CSRS people was the biggest secret in government. I feel in the last 10 years it's almost Roth TSP because the level of understanding out there is surprisingly lacking. Now we're fixing that, but boots on the ground with our people that are out there. There's just a whole lot of people going, oh, I didn't know I could do that, which I think is surprising when it's 10 years old. So go ahead. I'm sorry I cut you off.
No, it's no problem. I'm glad you're bringing that up. But Dan, I want to go back to what you almost said a few moments ago in terms of the misunderstanding. You've heard, oh, I didn't think I could put money into the Roth TSP because I was told my income's too high. Not true. What you're talking about here is the Roth IRA. The Roth IRA has the income limitations every year. Not the Roth TSP. Whether your income is, I'm talking about your adjusted gross income, Whether your adjusted gross income is $50,000 a year or it's $500 million a year. If you are a federal employee, if you are a member of the Uniformed Services, you are allowed to contribute to the Roth TSP.
100%.
No income problems.
100%.
Okay.
Agree.
And then later on, we're going to be talking about rollovers of the Roth TSP. And guess where you can roll over the Roth TSP? To a Roth IRA. And there are no income limitations for that, too. We're going to talk about that later.
Yep, that's our next podcast.
But right now, Dan, we're talking about this 5-year rule.
Yep.
And I'd like to go through my example that I wrote in the FEDZONE column. Because it'll really make things clear if we go to the example, okay?
So we're talking about Paul.
We have somebody named Paul, and Paul made his first Roth TSP contribution on July 15th, 2018.
Yep.
And he has made subsequent Roth TSP contributions until he retired from federal service on December 31st, 2021, this past December 31st. And Paul was 60 years old when he retired. Mm-hmm. He was over 59 and a half. So he met one condition. He's over 59 and a half. Let's see if he met the other condition, the 5-year rule. So since his first Roth TSP contribution was on July 15, 2018, Dan, go back to the previous January 1st. Yep. What is that? January 1st?
2018.
2018. So Paul's 5-year Roth TSP clock for qualified Roth TSP withdrawals began on January 1st, 2018.
Yep.
Okay. His 5-year Roth TSP clock, therefore, ends on January the 1st, 2023.
Yep.
On that date, he'll be over 59 and a half. He'll be probably 61. And therefore, he can make penalty and tax-free withdrawals from his entire Roth TSP account. Now, I'm going to ask the question, because I've gotten this question. Suppose Paul forgot about this 5-year rule, and he told the TSP this year in 2022, I'd like to get a monthly check from my TSP account. I would like to get $1,000 a month. You can do that.
See where this is going. Yep.
Okay? Now, if Paul does not specify to the TSP that he wants the $1,000 to only come from his traditional TSP account. Remember, he's over 55, so there's no problem taking out the money from his traditional TSP account. There's still going to be no penalty. He has to pay tax, but no 10% early withdrawal penalty. If he doesn't tell him, take it only from the traditional TSP account, and he could, the TSP is going to take it out what's called pro rata, according to his account balance.
Yep.
Whatever the balance is, whatever dollar-wise what he has in his traditional TSP account as of the last day of December 31st, 2021, versus his balance in his Roth TSP account. So let's say he has $800,000 in his traditional TSP account, and he has $200,000 in his Roth TSP account. So 80% is from the traditional TSP, and 20% is in the Roth TSP. So of the $1,000 that Paul's going to get during 2022, $800 will come from the traditional TSP, all taxable.
Yep. Yeah.
And $200 is coming from the Roth TSP. So what's going to happen tax-wise with the $200? What do you think, Dan?
I'm not a cynic, but I think whenever the coin could flip in favor of taxation or non-taxation, I always bet on taxation.
And you chose the right one, Dan, because
I chose wisely. Okay.
because Paul's going to have to pay tax, federal tax and state tax, on the earnings portion of that $200. Does he have to pay an early withdrawal penalty? No, because he's over 59 and a half.
Yep. That hurts my heart. Well, this is, this is a sort of a global plug here, folks. And you're going to hear this more and more. It's a commitment that we're making now within Serving Those Who Serve. The model that is out there is that federal retirement under FERS is a three-legged table. So yes, you've got FERS pension, you've got TSP, you've got Social Security. You can't just set it. You can't just show up. You can't just show up. I'm going to say that right now. Gone are the days where you just show up for work, you put in your time, and everything happens. It's just not there anymore. We have put this out there for years. It's the fourth leg. It's strategy. You got to have a plan. You have to have a plan. You have to put thought into this. You can't just show up, put in your time, and everything's going to work. That's not a complaint. That's not a lament. It's just the reality. Because the one thing I don't want any dedicated federal servant to put in a lot of years and find out that they set themselves up for subsistence in retirement. I want you to thrive in retirement. So, yeah, that's me on my soapbox. If you've listened for a while, you know I do that. You're going to hear this more and more. You know, that fourth leg is strategy, and that's a drum that we're going to keep beating here at Serving Those Who Serve. Ed is central to that. What he's bringing up is, yeah, you got to know how these things work, and you got to have a plan for doing it. So, hey, good stuff, Ed. I think it's a great place for us to break. Folks, don't forget, come back for the next one, because we're going to be talking about TSP and Roth TSP transfers and rollovers, because that's an important topic for everybody. Ed, I'll say it again, you really are a gift to us and to the federal community. What you bring to everybody out there, what you teach us, it's just amazing, and we're very grateful to you for that.
Thank you. My pleasure.
Folks, that is a wrap. We are Serving Those Who Serve. Be sure to subscribe to this podcast on our YouTube channel and Spotify. Remember to share it with your friends and strangers. Check us out on Twitter and LinkedIn, and don't forget those live webinars. They're every week, folks. And just go to that menu. You will see there's always opportunities for you to sign up. We're not gonna put a clicker on you and say, hey, you've already come to a bunch, you can't come. Nope. And that means the guru will come to you. You can watch these in your bunny slippers if you want. Reach you where you are, teach you where you are, when you serve you where you are. Share the page with your friends. They will thank you. And do not miss Ed every week in the FEDZONE. That's at fed-zone.com. So for Ed, the crew at Serving Those Who Serve, and me, Dan Sipe, good luck, Godspeed, and above all, it is your FedLife. Have a strategy and make it a great one, because you deserve it. Stay well, everybody. We are out.
Thank you for listening to the FedLife podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Raymond James is not affiliated and does not endorse the opinions or services of any of the quoted professionals or their respective firms. Any opinions are those of Dan Sipe and not necessarily those of RJFS or Raymond James. This case study is for illustrative purposes only. Individual cases will vary. Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organizations.
Neither Raymond James Financial Services nor any Raymond James financial advisor renders advice on tax issues. These matters should be discussed with the appropriate professional. Investing involves risk, and you may incur a profit or loss regardless of strategy selected, including diversification and asset allocation.